Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's jump right into a massive legislative shift that's heading our way for tax year 2026. We are talking about the brand new no tax on overtime deduction introduced by the OBBBA. Look, if you have wage-earning clients, they are absolutely going to be asking you about this. So in this explainer, we're cutting through the noise. We've dug deep into the statutory guidelines, the strict IRS formulas, and the new reporting rules to give you exactly what you need to navigate this upcoming filing season like a pro. Let's see how we're breaking this down today. Here's our game plan. First, we'll hit the new deduction limits. Second, we'll cover the FLSA overtime eligibility rules. Third, we'll calculate the premium portion. And spoiler alert, this is where your clients are going to be the most confused. Fourth, we'll look at employer withholding and reporting. And finally, we'll wrap up with tax filing and correcting errors.
Okay, kicking things off with Section 1, the new deduction limits, caps, and phase-outs for tax year 2026.
So what is the actual bottom line here? The core deduction cap is up to $12,500 of qualified overtime compensation per individual. And if you've got clients filing a joint return, that maximum limit effectively doubles to a whopping $25,000. Now, here is a really crucial takeaway. This is an income tax deduction that's available whether your client itemizes or just takes the standard deduction. It's a fantastic benefit. But before they start spending those tax savings, we do have to talk about their overall income.
Yeah, there's a catch. This deduction phases out based on some pretty strict income limits. Basically, the tax benefit is reduced if a taxpayer's modified adjusted gross income, or MAGI, creeps over $150,000 for individual filers or $300,000 for joint filers. So for your high-earning clients, this deduction might literally provide zero benefit. You got to screen for these MAGI thresholds early on before you do any heavy lifting on the calculations.
Moving right along to Section 2. FLSA overtime eligibility rules. Who actually qualifies for this thing?
This is where it gets really fascinating and honestly a bit tricky. The deduction relies entirely on the Fair Labor Standards Act, or the FLSA. To deduct a single dollar, the overtime must be legally mandated by Section 7 of the FLSA. The IRS is completely inflexible on this. If an individual isn't eligible for overtime under the FLSA, they do not receive, quote, qualified overtime compensation. Doesn't matter if an employer voluntarily pays it or if there's a union collective bargaining agreement in place. If it is not federally mandated, it simply doesn't count. Because of that, you have to be hyper vigilant about common FLSA exemptions. Executive, administrative, and professional employees, they're generally exempt. Same goes for outside sales staff and certain IT folks. But here is a massive red flag for your small business clients. An employee who owns at least a bona fide 20% equity interest and actively manages the business is considered an exempt executive, so no, business owners cannot just artificially authorize overtime for themselves to generate a slick tax deduction. All right, Section 3, calculating the premium portion. Get ready, because this is the biggest client misconception by far. Your clients are absolutely going to walk in assuming their entire overtime paycheck is fully deductible. They'll think, hey, I worked 10 hours at $30 an hour, I can deduct $300, right? Well, unfortunately, no. The reality is they can only deduct the 50% premium portion that is minimally required by the FLSA. The regular straight-time portion of that work, completely excluded. Let's break down how incredibly strict this IRS formula actually is. It's FLSA hours, worked over 40, multiplied by 1/2, multiplied by the employee's regular rate of pay. Let's put that into perspective. Say an employer is generous and pays double time. Under the IRS rules, if a worker's regular rate is $20 an hour and they get paid $40 an hour for 10 hours of overtime, which is $400 total, only the mandated halftime premium actually qualifies. That's just $10 an hour for 10 hours, so $100 total. That remaining $300, still fully taxable. Let's pivot to Section 4, employer withholding and reporting. We need to talk W-4 adjustments and W-2 requirements. Here is a major rule you need to drill into your corporate clients. Standard income tax withholding still applies to all overtime compensation. An employer absolutely cannot just unilaterally reduce tax withholding on an overtime check to account for this new deduction. If an employee actually wants to see that tax benefit right away in their regular paycheck, they have to actively submit an updated 2026 Form W-4, specifically using the Step 4B deduction worksheet. And as detailed in the official IRS fact sheet that dropped this past August, the burden of calculating and reporting this highly specific premium amount, that falls squarely on the employer's payroll department. Starting in tax year 2026, you're going to see a lot of this. Employers must report the total qualified overtime paid on Form W-2 in Box 12 using the brand new code TT. And get this, the employer has to report the full amount of qualified overtime paid, even if it blows way past the employee's $12,500 deductible limit. The employer's only job is to report the raw qualified number. It's our job as tax practitioners to apply those limits when we actually file the return.
Finally, bringing it home with Section 5, Tax Filing and Corrections. How to prep Schedule 1A and fix those inevitable reporting errors.
So how does the workflow actually play out? You'll input the full code TT amount directly from the W-2 onto the new Schedule 1A. From there, the Schedule 1A instructions automatically apply the individual or joint caps, and they factor in those MAGI phase-outs we talked about at the beginning. The final number you get on Part 3 of Schedule 1A is the actual deductible amount that carries over to the 1040.
But wait, this brings up a massive, and I mean massive, compliance trap for the 2026 season. What exactly do you do if a clearly eligible client sits down at your desk, but their W-2 completely omits code TT, or the amount is just completely wrong?
Under Internal Revenue Code Section 225A, this deduction is legally changed to W-2 reporting, period. If the employer messed up the amount or left it off, they absolutely must issue a Form W-2C, a corrected wage and tax statement. If the employer refuses, your client is out of luck. You are strictly prohibited from using a substitute Form W-2, Form 4852, to try and claim this. On the flip side, if the employer overstated the amount on the W-2, you as the preparer can only legally consider the actual correctly calculated FLSA minimum amount. Just a couple quick final filing rules to keep in your back pocket. Married taxpayers must file a joint return to claim this deduction. And secondly, any taxpayer claiming this, and their spouse, if they're filing jointly, must have a valid Social Security number for employment, and it has to be issued before the due date of the return, including extensions. So to wrap up this explainer, here is the critical question for your firm today. Are your client questionnaires and tax organizers updated right now to flag this highly specific code TT requirement? Think about it. If a client drops off their documents in April without code TT, you are not going to have time to send them back to their employer for a W-2C. Is your intake process ready to prevent a massive wave of return delays? It's definitely something to prepare for. Thanks for joining us as we explored the OBBBA overtime deduction, and we'll see you next time.